is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Andrew, last week we talked about the meme coin bubble bursting and how there's going to be a shift towards fundamental analysis of blockchain projects. And we had a little conversation about what kind of metrics you might use to actually evaluate an application or a protocol that's doing something interesting and useful. So I want to build on that discussion from last week and talk to a project that we have discussed in the past and actually had on the show that I think is doing exactly that. And we're very fortunate to have Jelena Djuric, the CEO of Noble, join us. So if anyone who's a fan of the show, and we know you all are diehard fans, Noble is an issuance platform for stablecoins and other real-world assets, also known as RWAs in crypto parlance. Noble's infrastructure proliferates stablecoin and RWA liquidity and functionality by unlocking fast, easy, and secure interoperability between blockchains. Noble is built to service the multi-chain ecosystem and has facilitated over $6.5 billion of transfers over the last year with connections to over 80 blockchain applications. So we've talked about stablecoins, RWAs, and the cross-chain and sort of multi-chain thesis, Andrew. Those are all real central themes of DeFi Decoded, and they're all kind of coming together now on in one nice and easy package on this call. So Jelena, thanks so much for joining us.
Thank you so much for having me. Pleasure to be here. I think it's the third time I've been on the show. So
is it the third time?
Third time's a charm, as they say.
You are like you might be one of our top 2 or 3 ranked
That's
guests.
Awesome.
You know, you and other esteemed leaders of the Web3 world have joined us on multiple occasions. It's very rare. So before we leap into Noble, both you and Andrew were actually at ETHDenver last week. Andrew did his, I think you were actually doing our pod last week from ETHDenver on like day one. So with the benefit of some hindsight and, you know, in light of the market meltdown that's happening, I just would love to get a vibe check from you guys on what's new in that community, but I know it's expanded beyond ETH to everything else. So what's your take after being there? Why don't you go first?
Sure. Yeah, I did a bit of a retro tweet thread a few days ago, and some of the things that I highlighted were like definitely the kind of community came together in more like intimate kind of environments, right? Like typically ETHDenver is like this big production and there's tens of thousands of people, and there's still a lot of people actually present. I don't think like the total like number of guests were like that much lower than previous years, but the actual sort of events and meetings were a lot more intimate and collaborative in nature. So in my opinion, it was very productive and very positive experience. Stablecoins are a major topic of discussion. I think from like a meme coin kind of speculative perspective, there's a lot of fatigue and people are pretty open about that at this point. So definitely a tempered environment, like maybe a kind of a psychologically, but in terms of actual sort of enthusiasm, like to build kind of productive things, that was still very, present. So yeah, I thought it was actually great, but I'm curious what Andrew thinks.
Yeah, I think that's a pretty good read of it. I felt like overall the mood was slightly down. I would say like slightly neutral to slightly negative. I found the attendance for events that I went last year, I would say was like moderately down, which was kind of surprising to me because we're like another year into the quote unquote bull market. But it's definitely been a very uneven bull market. Like, you know what I mean? And yeah. I'm sure like a Solana conference right now or like some sort of meme coin conference would be crazy. Whereas I feel like it was like slit, like, yeah, I would say that it was like a sort of muted mood is kind of like how I would say it.
One other thing very quickly, we also had the executive director of the Ethereum Foundation be announced on the last day, Tomas, which is also actually was kind of like a nice like punctuation to the end where people are like, oh, like if the Ethereum ecosystem is like coordinating and everyone is trying really hard to like fix the problems, which to your point is important.
Yeah, no, and I'm actually the conference made me very bullish actually.
Yeah.
I think,
What doesn't
Like-
make you bullish, Andrew?
I mean, okay, put it this way. It didn't feel like a conference at the top of the market is how I would say it. Like
That's
having been,
for sure. I wasn't even there, and I could tell the vibes were pretty muted.
like I was at Consensus in early 2018. So like just as the market was starting to come down, and I forget which conference. I was at one of the conferences right, literally top of the market 2021. And those were insane. Like those were completely just madhouse. People like crazy deals being done. Just a very different vibe.
Yeah.
And this conference was not like that at all. I feel like there's a bit of a return to kind of like a focus on fundamentals, but also a return to like, hey, like we're here to build decentralized, fundamentally sound tech. I thought that was really actually quite encouraging.
Yeah.
So for me, it actually made me a lot more bullish. I think there's also a way less, for example, I guess this would have been 2 or 3 years ago. Like there was crazy DeFi stuff happening. Everyone's talking about like, where can I get yields? There's almost none of that right now. There's a little bit, but like there's not too much. So I would say like there's definitely a lot of interest in sort of AI agent stuff, which I thought I personally think it's still pretty early, but for like decentralized AI, but kind of interesting. A lot of interest in DeSci as well. This decentralized science movement. Again, it doesn't totally make sense to me right now, just how it's currently constructed. It kind of just seems like meme coins attached to academic papers, but
Arguably better.
Yes, better for sure. But
Then
but to me,
attached to celebrities or
other
things.
But again, that's very bullish, right? Like the far out on the risk curve is, I think, things that like maybe they don't totally make sense in their current structure, but they're actually trying to build like fundamentally sound businesses or like trying to kind of advance a noble cause. So I kind of came back from ETHDenver very encouraged, actually.
Me too.
So
well, that was a good transition because I wanted to talk about narratives. This is a narrative driven market, and for better, for worse, probably for worse, meme coins have kind of dominated the narrative. And I think the speaking of punctuation points, the incoming president launching his own meme coin, if it wasn't the top, it was a signal of the beginning of the end, I think, for that cycle. So some of these other themes that you're talking about, stablecoins and RWAs, DeFi, there's other stuff, DePIN, DeFi Renaissance, all that stuff. Like these are not new narratives. These are narratives, like these are things that are in development and have had moments of, a lot of interest. I remember there was like a little mini DePIN summer that occurred, I think maybe 14 or 15 months ago. And I'm just wondering if there's any evidence from the conference that some of these really cool ideas are materializing into really valuable, useful things.
Yeah, I mean, we co-hosted a breakfast on the last day with a bunch of stablecoin projects.
Yeah.
Like Mento and Perenna and others. And we had one of the founders of Cello come by as well to give a bit of a chat around how he sees, the stablecoin market emerging. And one thing that came out of that was, there's a chart, I actually tweeted it as well. It was a chart that Artemis put forward, and you see like an index of crypto tokens by value, kind of their total market cap. Like it's an indexed kind of value of the total market cap of like the top 200 coins or something like this. And then relative to the stablecoin issuance, the stablecoin supply. And it's actually, the market cap is going down, whereas issuance is going up. So there's still like things like there's still like very positive trends actually in crypto. And most of that is on the RWA and stablecoin side right now, right? Like, you have many kind of TradFi institutions like Franklin Templeton and obviously BlackRock and others sort of coming to the forefront and saying we're going to tokenize various funds. We want securities on chain. You have Robinhood and their CEO Vlad Tenev saying, tokenize everything. So on one front, there's a lot of positive signals, both from like an intention perspective, like we're doing real things now finally around the RWA space, and then also from a numbers perspective, you actually see that being proven, at least on the stablecoin side. And actually also on the RWA side, though that's a bit harder to measure at the current moment. And yeah, you have like businesses being built around these, technologies, right? These assets, right? You have like an interesting like invoicing company, you have interesting payments companies, you have, DeFi projects like Noble kind of coming to the forefront and saying, we're going to, have a better way of distributing real yield on chain to real people. And yeah, so there are like real things happening, right? It's like my message. It's just maybe not as like attractive from a like numbers perspective right now, right? Like when you hear of like all the volume that was being done through Radium and Pumped Up Fund and all the fees being earned, obviously those are big numbers, and you don't have that right now. Unless it's like meme coins. I mean, Uniswap's actually doing quite well from a revenue perspective, but and there's Jito and Solana as well. So like there is real revenue being generated, especially on chain. But again, like it's very concentrated among like very specific projects, and I think soon that'll change. Yeah.
Okay, cool. Well, why don't we use that as an opportunity to segue into Noble, Jelena? So speaking of real projects doing real stuff, I love how real is like the ultimate compliment now in crypto. So last time we had you on the show, you were telling us, I'm trying to remember exactly, but you were the preferred partner for Circle launching USDC on Cosmos.
Yep.
And based on the introduction that I just provided, kind of setting the stage, you've done a whole lot more than that since then. So tell us a little bit, just get everybody on the show caught up on what's happened over the last year for you guys while everyone's been distracted chasing the shiny bouncing ball of meme coins or Trump trades and all this other stuff. What have you been building?
Yeah, it's a really good question. Again, I'm trying to remember exactly when we did the show, but let's just like take it back maybe a year or so just to set the stage. So we launched native USDC in Cosmos in late September of 2023, right? So about a year and a half.
Exactly 1 year ago.
Oh, okay. Wow. Yeah. That's
can you believe it?
Like March 4th, 2024?
Well, I don't know about exact.
Okay. That's awesome.
It was January 25th, 2024. So actually it was 13 months ago.
Amazing. Okay. I know exactly what was happening at that point. So we launched native USDC for the Cosmos ecosystem late September. By January, when we had the show, it got to about 100 million of TVL. And then since then, we reached an all-time high around 560, 580 million of TVL. And right now we're at about 450. So obviously, with the markets with where they are, like that number has gone down somewhat, but honestly, not as much as you've seen on other protocols, because what we've built is like fundamentally, hedged against like all of the volatility, right? Like people want stable coins at the end of the day, right? Like a lot of the volatility that we see with like TVL and like protocol revenue, a lot of that is in the speculative space, right? Whether that's meme coins or even just, trading, certain crypto assets. And so Noble, of course, started with the intention of bringing native USDC cross-chain to 50 plus Cosmos chains. And we built the infrastructure to allow us to do that, right? Everything from routing to a superior user experience, both for end users and developers that leverage this native stablecoin liquidity. And of course, since then, we've also brought a number of other asset issuers on board. So we support Ondo's USDY, which is also a yield-bearing asset backed by T-bills. We have Hashnote's USYC, which is a tokenized T-bill, actually. It's a security technically, so very permissioned. They actually recently were acquired by Circle as a company. And we have Monerium, and they issue a euro. So we also have the euro on Noble. And now the kind of latest asset, of course, is Noble Dollar. Yeah. So let's
talk a little bit about Noble.
Yeah.
Go ahead.
Sounds good. Yeah. So
you know where I'm going with.
So we are launching Noble Dollar tomorrow, so March 5th. Not exactly sure when this show will come out, but obviously we've been doing a lot of research into like what is the market.
March 5th, 2025.
Yes.
For those of you in the future who are watching this
Exactly.
using noble dollars in your everyday life. Okay, you heard it here first. Go ahead.
Exactly. So we're launching at Noble Dollar in partnership with a team called M0. M0, like money supply, you have like M1, M2. M0 is like the kind of idea, right? A substrate for kind of increasing, in this case, stablecoin issuance. And so what M0 has built, which we're the first partners of, is effectively a way of minting dollars. So in the same way that you mint USDC or Tether, collateralized by T-bills, in the same way that Tether and USDC are, but in a way where you can programmatically pass on the yield to different stakeholders. So it's a very customizable, programmatic kind of method of sharing the yield, collateralizing those dollars sort of on chain. So one way that I describe it is if you put Circle and MakerDAO together and you had a baby, it would be M0, right? In the sense that on the MakerDAO side, it's over collateralized, 105% in the way that DAI is, or USDS. It's extremely, again, DeFi native, so it's very permissionless. It's a very, kind of easy to access. But it's like your typical kind of traditional stablecoin in the sense that it's always pegged to $1 in a very safe way, right? Because you're collateralizing that dollar with real T-bills held in real bank accounts, in this case, offshore. So we're very grateful because Noble Dollar is an application of M0's technology, right? So we're taking what they call M, stands for money, from Ethereum. We're taking it to Noble. We're wrapping it effectively and white labeling it as USDN or Noble Dollar. And by doing that, we have the ability to say, all right, new kind of perps decks. Obviously, you need stablecoins, and what better way of kind of launching with the dollar than, in this case, USDN, where you can decide, hey, we're going to pass on, in this case, the 4.3% yield entirely to our users. We're going to actually, let's say, subsidize liquidity pools. We're going to do a buy and burn of our token. It's literally like revenue for the protocol that you don't get otherwise.
Right.
Yeah, that's really interesting. It's kind of like what it reminds me of a little bit is almost like Blast for not a good.
I know it's funny that you say that. No, I get it.
Yeah. But Blast pioneered. It was essentially an L2 that staked all the ETH on the L2 and then passed the yield to the users and I think the application developers. So if I'm like an application developer, this opens up potentially a new revenue stream where I could monetize effectively the TVL of my users. And then like you said, pass that on either through incentives and or just like lower fees.
Yep.
Which is actually really interesting because if you think about like a normal business that you're often allowed to take customer deposits and invest it in like treasuries and like earn that yield. Whereas up until now, it's been effectively, haven't been able to access that yield in any way. I guess, how does it work? It's interesting to find out. Are you guys working with chains directly or with applications? Because I would think you would almost want to work with chains potentially, right? Because they're the ones custodying most of the assets. Or how are you guys thinking about go-to-market?
Absolutely. It's a great question. And, I actually do like the Blast analogy, even though it wasn't a stablecoin yield or real world yield, it was still like in principle kind of a similar concept. So for us, I should preface this. So for the next couple months, Noble Dollar will only be available on Noble just to start, right? Like we want to, again, this is like an experiment, like in a good way, right? We want to show that, first people like end users and, institutions, companies, they want a way of like reliable, safe yield on chain that is, again, very permissionless, instant, et cetera. And that's USDN. And so alongside that, we're also launching a points program just to get people sort of, kind of excited. I can actually give some notes on the points program, and then we could talk about USDN issuance to other protocols, other chains, which yes, that is actually the focus to other destinations. But yeah, just briefly on the points program. So we're doing this kind of game where to get people, again, like kind of excited and understanding like what Noble is, like how it's collateralized, what Noble Dollar is, how it's collateralized. We're launching 2 vaults. alongside the points campaign. So first vault, you can lock up your USDN for a specified period of time. So 1 month, 2 months, 3 months, 4 months. After each kind of time period, you get points and then a multiple on your points the longer you lock up. But what you do is you forego the yield. You forego the 4.3%, which is the current T-bill rate, the current short-term T-bill rate. So you just keep your, dollars, which are safe. Again, these are real dollars collateralized by real T-bills. This isn't like algorithmically collateralized or anything like this. These are real dollars. So there's like safety to this, and you get points, but again, you don't get the real yield. Or there's a second vault where it's called a flexible vault, where you a boosted yield vault. I should note that, because what happens is you deposit your USDN into this boosted yield vault, and all of the yield that is foregone in the staked vault gets redirected. So you can imagine 5, 10, 15% of real yield that you could claim at any time, and there's no lockup, and that you just accrue based on how many people are staking their USDN. So you can imagine, right, if most people are excited about points, right, and they're like, you know what, I just want noble points. We'll see if they're worth anything in the future, but I really want them. Then that's great for the boosted yield vault, right? But if people in the market just demands yield, like real yield, then obviously that number won't be as high. But it'll still be more than 4.3%, which is the real yield rate right now. So yeah, I mean, we can even talk about macro conditions that affect this game, right? I think Alex mentioned it in the intro, people are looking for sources of yield that's safe, right? And I think stablecoin yield is one of the most interesting ways to do that right now.
Yeah. Well, let's take a step back because to set the stage for a lot of our listeners, stablecoins have been the fastest growing asset within crypto, and are now at over their all-time highs in terms of circulating supply.
Yeah.
And the dominant stablecoins still to this day, remain USDT and USDC.
Yep.
And USDT, which is issued by Tether, is this juggernaut and has made Tether one of the most profitable companies in the world, I think. They generate something like $10 to $12 billion per year of earnings.
Yep.
They have certainly one of the highest earnings per head count in the world. Maybe there's a couple hedge funds that can say that they do better, like Citadel, but even then I'm not even sure.
Yeah.
But their whole business model is basically built on not passing through yield, right? People, mint USDT, Tether goes and buys treasuries.
Yep.
The interest on those treasuries accrues entirely to Tether.
Yep.
And the people who are using those stable coins haven't seemed to mind, because they're using it primarily as a short-term instrument for trading crypto. Even when they hold it, they haven't really had an expectation of generating yield, because honestly, even in the real world, if you hold money in a checking account, for example, you're not really generating very much yield. Now that's because banks are keeping it all for themselves, kind of similar to how Tether is. So we seem to be entering this new period, this evolution of stablecoins, where it's not a given that all the yield should go to the issuer of the stablecoin. And in fact, it should go to maybe the user or to someone else in the value chain or whatever, right? So to me, it's Noble is a company that is among a handful that it seems to be pioneering new ways to think about stablecoin yields. And yields are really just interest. And interest is credit, and credit is the foundation of the financial services industry, right?
Yeah.
So if you believe that, more and more RWAs will be tokenized, and those could include other currencies like euros, or they could include stocks and bonds or any other asset, then there's going to be a whole bunch of payments coming from those instruments in the form of dividend yields, coupon payments, and so forth, that can be customized and programmed differently, right? And so it seems like you're starting with the premise that the on-chain world, in a way, should embody aspects of the way the world works today, but with certain improvements, right? Where things can be done better. So I guess the thing that really interests me is the idea of composable yield.
Yeah.
So this idea that, you've got a USDN and there's a yield that comes from these T-bills. And if an application uses that stablecoin, they can keep all the yield for themselves, make money off the float, basically. They can pass through 100% of that yield to users. Like, let's say it's a perp exchange, and if you've got money in cash and USDN, you're earning the full yield, or it might be sort of half and half, right? And so that's something that they can decide in real time by sort of electing to open, like to pass through all the yield or some of the yield, right? Is that basically correct?
Basically correct. So when we say composable yield, we mean you can literally control the interest and where it's diverted based on a certain kind of body of decision makers, whether that's the validator set, whether that's a DAO, whether that's literally a multi-sig. Doesn't really matter. The protocol developers get to decide how to configure that. And that's exactly it. And you could do that again in a very programmatic way on chain. You could say, for the next however long, for whatever reason, we're passing on the yield to the end users entirely, or we're, running an incentive campaign or what have you. And you could do a buy and burn of your token, right? Like that's actually a really important piece of this discussion, because as we know, right now there's a big challenge around token launches, right? Like where, it's kind of like down only. Well, you can imagine that your revenue of your stablecoin issuance can be a way to actually control for that supply and control for that for those movements. And so we're excited in the same way that DAI is very composable in a lot of ways. You can collateralize it in different ways. There are different yield opportunities. We actually think USDN, which again fundamentally is built on M0's infrastructure. So this is like the M0 model. We're just the first distributor of this model and of this token. We believe, again, developers will kind of be excited by.
Great.
Yeah.
I love it.
Yeah, super cool.
I think like another thing that's interesting to note, and like I do want to give like a little bit of a macro perspective, and like Alex and I, we talk like kind of like politics, and we talk about like just generally like where the world is headed. I also think in a time of great uncertainty, like yes, people want the dollar, but people also understand that yields might stay high for the foreseeable future and even be higher or like not move much, right? Whereas like previously, in a time of like, the COVID crisis when we had such super low rates and everybody was borrowing money, that wasn't necessarily the case. And so for us, we also see that as an important part of the equation, which is interesting. Yeah.
It is interesting. What do you think, Jelena, speaking of like where the world is headed? So like we're in this moment where the U.S. has like Trump has really changed the strategy for the United States and the policies internationally. It's really like a go it alone strategy that he hopes will help to strengthen the U.S. But I think was probably going to weaken the U.S. and is going to lead to new kinds of alliances and shifting power dynamics in the world. And Mark Carney, who is one of the candidates for Prime Minister, still the Liberal leadership here in Canada, was also a central banker, and he actually gave a speech at Jackson Hole the last year. He was the governor of the Bank of England, where he talked about how like the reign of the U.S. dollar should come to an end as the global reserve currency, and that would be good for the world. And he went through the math. The U.S. was 15 to 20% of GDP. But the dollar was 75% of FX transactions and like 60% of global trade, right? And now that's and most third world or developing world debt is denominated in U.S. dollars, and this creates like this weird dynamics. And one of the things he suggested was basically like a synthetic digital dollar that would be backed by a basket of currencies, which is actually the same thing that Facebook wanted to do with Libra. And the Libra teams have all splintered and gone their separate ways and gone on to create really cool stuff like SWI and Psi and all these other things. But basically, like, I wonder if that's an idea whose time has come. The problem is it shouldn't be Facebook that creates it, because like that's an entity that can be regulated, if not regulated, like, the U.S. may not like the idea of a American corporation creating an alternative to the dollar. But I'm wondering if this is something that where like the on-chain economy is big enough and there's enough familiarity with using stablecoins that there couldn't be some kind of new Libra-like dollar that is tied to a basket of assets, right? That's held in offshore in a bunch of different places. I don't know. Maybe that basket is US dollars, gold, Bitcoin, Canadian dollars, francs, euros, yen, yuan. Like, I don't really know. I'd like to see the Canadian dollar in there, but maybe we don't make the cut. But I'm just wondering, like, is that something you think about? I mean, is that something that you think is possible in this kind of environment?
Yeah, I'd have to listen to the speech. I can't say I've heard this speech, but I definitely think.
I actually wrote an article about it in the Financial Post when that speech came out. So I'll send you. We'll put that in the show notes. I'll send you the link.
Please do. So I will say, I think one thing, Trump has made it extremely clear, like he is opposed to any form of CBDC. I'm not saying that this is like what Mark Carney put forward, but to be clear, where we stand, and I think like the current administration is very much in favor, is private stablecoin innovation. So, from that
private
perspective,
meaning like private sector, or private as in private
sector. Sector. So, yes, we should be experimenting with multi-collateral dollars that, kind of track, a certain kind of index of assets, whether those are fiats, whether those are bonds, equities, and so on. We've talked about this at Noble, actually, right? We're starting with short-term treasury bills, of course, because these are highly liquid, highly in demand assets that are easy to redeem and liquidate when people need them, of course, in terms of like in actual cash form, not in token form. But at the same time, there is, again, like a push towards just general tokenization of real world assets. I don't think this will be fiat currencies. I think that would be like a bigger problem, like for the collateralization mechanisms. I think it should probably be something like bonds, equities, things like this. Again, they have to be liquid. There has to be like a market for these things. I mean, honestly, just the redemption, like process, it's like we're still figuring out like innovative ways of like redeeming these assets 24/7. I will call out another project, which is Superstate. It's Robert Leschner's new project. He, of course, was the founder of Compound. They're really looking at becoming this like entity that can like do like almost like the experience you have with DeFi, which is like 24/7, always on. Kind of liquid markets, like when it works, with good pricing when it works, plus like the TradFi, like kind of experience of like, being able to do these like larger subscriptions and, again, like being like connected to the actual like bank or entity that is like facilitating these purchases, asset managers, et cetera. And so I guess like I don't have a perfect answer of how these assets will be collateralized in the future, these dollars, but whether it'll only remain T-bills or if it'll be a combination. I just think that at the end of the day, like to your point, it is unfortunate that like the euro, for example, it's the second largest currency on the FX market. I forget exactly what it is relative to USD, and yet it's like nowhere on chain, right? Or it's like very little liquidity. Yeah, I don't know if that's like about collateralization. I think it's more like around UX and pricing. There just isn't good markets for the euro on chain. That like.
Well, I think one of the reasons. Yeah, I know that this is no longer the case, but I think the U.S. dollar got out to a huge head start because even though the interest on U.S. dollars was pretty modest, there was still some yield. Like T-bills and treasuries never went negative yield. So like if you're Tether. Even if you're earning a very modest return, it still makes sense to mint USDT. But if it's a euro, like people forget, like there was $16 trillion of sovereign debt that was negative, like not real yield, like adjusted for inflation, just negative yield. Like basically you would buy debt and pay the issuer, in this case, like the ECB or Germany or something. Like it's totally bananas that happened. So anyway, but at the time, it wouldn't have made sense to build a business that's built on you earning some sort of interest margin because there was no interest to go around, right? And I feel like the USD got a head start. Like it would have been the natural to be the dominant player anyway because it's the US dollar,
Yeah.
but it got an added head start because there's no incentive. Now there is an incentive because there actually are real yields on euros, but it's still relatively, I think it is lower relative to the US dollar even today, right?
Yeah, just for the listeners, just for context, we had Tether launch in 2014. We could talk about like the macro conditions at that point, but I'll kind of fast forward to 2018, 2019 when USDC was launched, actually 2018. And then really it took off like in a meaningful way, like 2020, like during COVID. So if you actually like look at the kind of supply of USDC, really took off in the last 5 years. Of course, we had Terra, UST. We can talk about that. That reached a $40 billion market cap. Okay, 40 billion. Right now, the total market cap of these assets is about 220 billion. And this is like with like, strong institutions kind of back and with the yields as well, kind of backing these systems. So I think it's very notable that like there is a correlation between stablecoin issuance and how quickly that grows relative to macro conditions. When I say macro, I mean like in the real world and also in crypto, right? Because you can argue like in 2020, like the reason stables took off isn't because there was real yield, but there was just a lot of demand for crypto because interest rates were nothing and people were borrowing and they were going crazy at home during COVID and super bored. And that's why you got stable coins, right? Going up. Now you can argue people are not doing that because people are getting wrecked, but they still want stable coins because of the yield. So it's interesting. It's really interesting. I like to call stablecoins a recession-proof business, but we'll see what happens.
Well, we'll see.
Yeah. It's interesting that in a lot of ways, stablecoins are kind of they move opposite to a lot of the other lending markets in crypto, because like when treasury yields went up, stablecoin issuers did incredibly well. But it obviously hurt the competitiveness of sort of like traditional DeFi lending when you can just get like 5% on the US Treasury. I'm curious what do you think DeFi has been getting kind of, it's not been doing that well, I would say, on like a relative basis. Even though the fundamentals, I would say, have almost never been stronger. And we're starting to see a bit of a pivot in sort of DeFi projects towards profitability, return of capital to token holders. I guess I'm kind of curious, if you take a step back, like what do you think DeFi looks like in the next kind of like 1 to 3 years? Do you see any big sort of catalyst coming down the pipeline to get people, I guess, re-excited about the space?
Yeah, it's a really good question. I think maybe I sound like a broken record, but I think it's like it's all going to come down to how and where the yield is generated. Like you look at USDE and like Athena, I think that's like a really perfect example. Like that's not really your traditional stablecoin at all. It's obviously exposure to like the funding rate of ETH and things like this and Bitcoin. So I feel like that is an interesting model that people are like getting behind. I think it really depends on one. Can we break through the existing crypto kind of world where you have so few users, honestly, that are like actually participating in these markets? So like if Robinhood, for example, I suspect will launch a yield bearing stablecoin, TBD on exactly what that yield looks like and how it's structured. But I think people will get, like average people, I mean, right? Like they'll be more exposed, like, oh, these are like legitimate products and they're like easy to understand. And there's no like, staking or restaking, like my principal just grows. I feel like if you can keep it very simple for the end user, but have like kind of more complicated, interesting DeFi kind of management or like algorithms like on the back end, I think that's what's going to drive the needle, honestly. And I really just hope so, right? Like I feel like the worst thing we can do is just create like unsustainable DeFi products that like disappear overnight, right? Like UST did with Anchor and like that whole complicated mechanism, or other examples, honestly, in the space. Like you had this one project called Usual Money, like they kind of experienced like a massive sort of, kind of situation crisis where people, realized this is not a stable coin. It's actually a 4-year bond. Like I'm taking my money out. Like point being, these like assets and these products like need to be like safe. You do need some yield that's like hopefully above the real yield rate. Otherwise, like why risk it? Because I could just put my money. I mean, if you're in the US or Canada, I could put my money in some bank account that earns me that safely. But I think it's if it's like easy to use, if you can kind of exceed that real yield rate in like a legitimate, safe way, I think that's like what's going to be the catalyst. And again, I don't know what that mechanism is exactly right now, whether it's like the Athena model or something else, but a lot of people are working on it. And I think it's definitely a good evolution of what we had with like DeFi Summer and like DeFi 1.0, which was like the DAI model and the Aave model and things like this. So it's positive.
Certainly is. Well, it's like already been an hour. I feel like we keep going on this topic, but this has been such an interesting conversation, Jelena. Congrats on all this success. I think we should have you every 6 months instead of every year because too much happens over the course of a year, both in crypto and apparently at your firm as well. So thank you. I know that you guys are hard at work and we look forward to tracking your progress really closely. Just remind our listeners where they can keep up on what you're up to and use the product and, get more involved.
Absolutely. Yeah. Thank you so much for having me. So basically for the Noble Dollar kind of launch, we've built our own front end with a stable swap pool. Speaking of DeFi, that is on dollar.noble.xyz. And if you want to just generally learn more about us, that's on noble.xyz.
Awesome. Great. Well, that concludes today's episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Make sure to check out our next episode. It'll be out next week. And make sure to like, subscribe, and to comment on this podcast. Helps other people find it. Until next time, that's it for me. Take care. Bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.